Okay, today's bank is UMB Financial Corporation, based in Kansas City, Missouri. It's a really big bank. They've got a presence in most every state, something like 18 or 20 states or so. But yeah, so we can first take a look at the stock price and some of the statistics, and then they've got some interesting stuff going on. So it's going to be we can touch on a little bit of that. It's going to be a little bit maybe complicated. Rather, it makes it to where it's not as simple of an analysis. But so right now market cap's about 4 billion. The average bank in our population's somewhere between half a billion to 2 billion. So it's a pretty big market cap. Price earnings ratio of 11. That's about a 9% earnings yield, which is a little bit on the low end. Not too bad. And if we come over to the statistics, we can see, price to book is about 1.29. It's a little bit higher than what we, average bank we see, but not too far outside the range. 0.86% return on assets. That's a little bit on the low end. We normally see something like 0.85% to 1.05%. So within the range, but a little bit on the low end. Return on equity is pretty average as well. So it seems like the bank is priced, perhaps on the higher end of the normal range that we see, but not too egregiously bad. Or rather, its profitability is on the lower end. But it's a really large bank, so maybe some of its risks mitigate a little bit of that and make its shares worthwhile. So we can dig into things. The first thing that I wanted to point out is that they recently announced that they are acquiring Heartland Financial USA. And I believe they are paying 0.55 shares of UMB for every share that Heartland has outstanding. I was trying to see where it is in here. Here it is, yeah. So 0.55 shares. So that would mean, if we were going to calculate that, we could look at Heartland's price, which more than likely it equates to somewhere around $44-$45 a share, because that's where the price is, right? But we could recalculate it by seeing how many shares of Heartland are outstanding currently, and that's about 42.79. So if we multiply that by 0.55, that gets about 23.53 million shares of UMB that would be issued. And so if we were to multiply that by the current share price, that's about $2 billion purchase price for Heartland. So if UMB's market cap is 4 billion, then and Heartland's is 2 billion, then that means that Heartland's about half the size of UMB. Perhaps a little bit smaller, because they're probably paying a premium compared to what the bank has been before it jumped up. You can see that now Heartland is about 27 times earnings, which is pretty expensive. Most banks are being traded in the market right now for 9, 10, 11 times earnings. So they're paying a big price for Heartland. And we did look at Heartland back in March. We decided not to buy it at that time because we felt like there were a couple of risks in place. The capital risk and credit quality risk. We felt like were too high. Also around about that time, several of the members of the executive team resigned. So we felt like they were kind of in a bad place, but maybe that's why they ended up selling to UMB. Might have been their only option to get some leadership to run the thing. So maybe a good deal for both parties. I just wanted to bring that to light because it's with Heartland being potentially about half the size of UMB, then it has a pretty big effect on the future earnings and assets and liabilities of the company and stuff like that. So if we wanted to spend a whole lot of time on this, we could take UMB's financials and Heartland's financials and combine the balance sheets and the income statements and see, and then adjust for any business combination fair value adjustments types of things, and sort of make a projection for what do the earnings for the combined company look like, as well as what are the assets and liabilities, the structure of that look like, and then make a determination from that. But that's just a little bit too much right now. Eventually I don't think they have yet, but eventually they'll probably put out some pro forma financials that'll tell us what does the combined company look like, and then so they'll do all the legwork for us and probably be more accurate anyway than our estimates and stuff. So plus I don't think the shareholders or the regulators have approved the merger yet either. So it's kind of just up in the air. So I think that what we'll do is maybe look at UMB standalone, and then pepper in some considerations of Heartland, maybe like we said in our analysis from back in March, Heartland maybe had an inadequate capital or liquidity base, inadequate reserve on their loans. So we can maybe consider that in conjunction with UMB. Perhaps the capital and liquidity of UMB can support some of the lacking that Heartland has in those areas, and that might have been the plan for the merger anyway. But anyway, so let's dive into UMB and make some considerations on Heartland throughout. So all right, so first, so on the asset side, they've got their assets structured a little bit differently than what we might typically see, at least the order of them on the balance sheet. So they've got the loans first, then securities, and then the cash, and then the other goodwill, accrued income, that type of stuff. So immediately we see that as far as the percentage of loans, it's a little bit lower percentage than what we would normally see. So it's about 52% the loans is of the assets. So that's a pretty low percentage. We would normally see somewhere between 68 to 74% of loans on the balance sheet. So and then the securities are a lot more. So securities, both the available for sale and held to maturity, the debt securities at least, ends up being about 27%. So that's on the high end of the range of what we would normally see. So, the cash is way more. So interest-bearing due from banks, it's a little over 15%. So most banks will have 5% or less. So they've got about 3 times the amount of cash of the average bank. They also have a whole lot of securities. And then all that comes from a lower percentage of loans on the balance sheet. So I could see that they have a really good liquidity position, but perhaps not earning as much interest income because they're not allocated as much toward loans. Since loans typically yield higher than securities and cash do. But so that's the stance there. They've got a little bit of goodwill, but not a whole lot. So looking at the liability side of things, they've got a whole lot of non-interest bearing deposits. So that's awesome. It's about 31% of the liabilities. Normally we see somewhere between like 20-25%. So 31% is a big percentage, and that probably makes their interest expense be a lot lower than the average bank. So that's awesome. And then the other interest-bearing deposits comes in at about 56%, which is pretty low. So they actually have a lot of repurchase agreements here, which typically come at a lower yield. They're typically overnight, so there's a interest rate risk there, but it's a cheaper source of funds, I believe, than getting funds from the FHLB, which I think is what the 1.8 billion here is. But so anyway, it looks like on the liability side, since they've got they've got more non-interest bearing deposits, and also a lot of the liabilities allocated toward the repurchase agreements. I feel like the interest expense is going to be lower than the average bank, and perhaps we might see the interest income to be either average or lower as well, and that might put them in a pretty good net interest income position. So if we come down here, we'll be able to see how that looks. So we can see the interest income, 520 million. That comes out to about 4.88%. So that's a pretty low amount right now. It's within the normal average range, but it's on the low end of the range. So I think our guess earlier about how they're a little more allocated toward cash and securities puts a damper on their interest income. But that's in favor of liquidity also, which is also valuable. So that is where the interest income stands. It's interesting, the loans, 385 million. That's about 600 or that's about 6.5% of loans, the loan balance. So that's a really high yield. Basically in our statistics, what we normally see is somewhere between 5.5%. So they're yielding 6.5%. It's interesting that it's so high, but as we discussed, there's a lower allocation to the loans, so it doesn't enter into the full interest income that well, unfortunately. But once we get into the loans, we'll be able to see how they're allocated and maybe why that is. Anyway, on the interest expense side, we have 280 million. That's about 2.72%, which is a little bit on the high end. We're normally seeing somewhere between 2.5, something like that. So 2.72% is on the high end. I was expecting it to be a little bit less because of the allocation toward non-interest bearing deposits, and also cheaper sources of funding. But yeah, so we'll be able to see a little bit more about that when we get in the footnotes. That's unfortunate, but that leaves the net interest income around 240 million, which is 2.11%, and that's really, really low. We usually see somewhere around 3% for net interest income, so they're earning a really low net interest margin, unfortunately. So then getting into the non-interest income, they've got a lot of, being a big bank, they've got a lot of sources of non-interest income. Trust, securities processing being the major one. Of course, service charges on the checking accounts and stuff. They do trading, investment banking, credit cards, debit cards, brokerage fees, all that kind of stuff. So it really adds up to a lot of money. So 159 million is about 23% So that's about double of what we would see for most banks in non-interest income. So they're making really good money on non-interest income, and hopefully that maybe that helps out where they're lacking in the net interest income. Then we get down to the non-interest expense of 254, and that's about 37% of the revenue, which is pretty low as well. We typically see somewhere between 41 and 47. So not only is their non-interest income a lot more, their also non-interest expense is a lot less as well. So if you kind of put all that together, that gives them a net income of 110, and that's about a 0.97% return on assets, and that's right in the middle of where, actually on the high end of where we would like to see the return on assets. So it seems like the bank is pretty profitable. Even though they've got a lower net interest income, they've got a higher non-interest income and a lower non-interest expense, so that puts them in a position where they make pretty good money. And if we were to compare that to the market price of the stock currently, that puts them at about a 10.83% earnings yield, which is a pretty good yield as well. It's on the higher end of the range that we might look for. We usually see somewhere between like 9.25 to 11.25. So them being 10.83%, that's a pretty good yield. So not only does it seem like they have adequate profitability, but it seems like those earnings are at a reasonable price. Not having looked into any of the risks or anything like that yet either, but just out of a first glance. But another thing to consider too is that with the acquisition of Heartland coming down the pipe, they're going to end up spending a lot of money on attorneys and advisors and all that kind of stuff, and that's really going to eat into the non-interest expense. So probably however long that takes, the next year or so, and I don't know how much money that will be, but in some cases it can be 40 to 60 million dollars, and that'll be come straight out of the net income, which would be half of a quarter's income basically. So really not too bad. And once they present financial results and projections and stuff, they pull that out as kind of a one-time occurrence type of thing. But it is real money that shareholders don't make. So just something to keep in mind for the future. Now we can come down into the footnotes and see if we can see what else is going on, get some more specifics of the earnings and the various risks. So so the name of the bank is UMB Bank, National Association. They've got branches in about 18 states or so. So pretty big, widespread, diversified geography. And skipping down through here, they start out with the loans, so we can see the majority of the allocation of the loans is commercial and industrial, and then commercial real estate. So those two together represent more than 80% of the loan portfolio, and that's probably why we saw such a high yield on the interest income, or the loans interest income. And then the next bucket is consumer real estate, which represents about 12%. It's a little bit on the low end of what we would normally see for community bank portfolio, but we can see they're very heavily allocated toward commercial loans, either C&I or commercial real estate. So there's some risks that come. Those are of course higher risk than the residential loans, but they also come with a higher yield. So from a credit quality perspective, we've got the past dues and non-accruals here. So if we add the past dues plus the non-accruals, we get a total of about 36 million. And that's a really, really small amount, about 0.15%. That's way below what we would see for most banks. So it seems like they've got a pretty good credit quality. And then at least for the non-accrual loans as well, so 17 million. That's 0.08%. That's it's probably like an eighth of what we would normally see for most banks. So really good loan portfolio that seems good quality. And then we can kind of see I wanted to see the classified loans as well. Here we go. Yep, so the ones that are substandard and below would be classified loans. So if we add those up, they've actually got this kind of spread out in a lot of different places. So this is just the here's the asset-based loans, and then agriculture. So we've got 150 million plus 1 plus 9, and they've it's 2024 and then 2023. So we really got to pay attention. But so for the commercial, looks like the C&I loans, they've got about 160 something million. And then coming a little further, we can see that the commercial real estate, and it's this owner-occupied, non-owner-occupied, so on and so forth, have a little bit more. And then they've got more of the residential lending, so the home equity line of credit, 1 to 4 family, then the junior liens, and then they have the more of the consumer loans, like the auto, credit cards, that type of stuff. Or sorry, just personal loans. Then they've got the credit card accounts down here. We can see it's about 20 million that are past due. So anyway, if we were to add all that up, it comes to about 238 million of classified loans. So those are ones that are more likely to that currently have issues, and more than likely they're not going to collect the full amount, either through the collateral or through pay down on the loan. So of course they're not going to lose the entire amount, but there's a chance that it's more than likely that they won't be repaid the full amount of principal that's due. Anyway, so 238 million of that is 1% of loans, which is on the low end. We normally see somewhere between like 1.10 and 1.7. So them having 1% of loans classified is really low amounts. That means they've got a pretty good credit quality there, and we already saw that because of the past dues are lower, the non-accruals are lower. So to see if they've got an appropriate reserve in place for loan losses, we can compare that to the allowance for credit losses here. So they've got about 226 million of allowance for loan losses. So that compared to the total we had, what was it, 250 million? Sorry, 235 million. So they reserved 226 million for loan losses, but the amount of classified loans is 235 million. So those are pretty close together. The allowance itself comes to about 0.96% of loans. That's a little bit on the low end, but as we saw, they've got almost no past dues, almost no non-accruals, and also this reserve amount relative to the classified loans is about 96%, which is within our range of what we usually like to see for that ratio. We usually see somewhere between like 92 and 150% of the allowance for loan losses divided by the classified loans. So I feel like they're pretty well reserved. And even if you were to look at the ACL, the allowance for credit losses, or at least the allowance for loan losses, ALL, as a percentage of past dues, it's about 625%, which is crazy high reserve. Most of the time we see somewhere between 200 and 400%, but these guys have accrued, double the reserve compared to past dues than most banks do. Also, compared to non-performing loans, there's not a whole lot of non-performing loans. It'd just be the non-accruals plus 90 days and accruing plus the Oreo. But they've got about 1,000% of the reserve is 1,000% of the non-performing loans. So I feel like they're really well reserved for the loan losses, and even the loan portfolio is pretty high quality anyway. So I feel pretty good about the credit quality then. And so skipping down a little bit, we can get to the securities as well. It's interesting, they've got quite a bit of state and political subdivisions, so more like munis, at least more than what the average bank does. So this is just the available for sale. So we've got also, go down to the held to maturity, which is down here as well. So if you were to combine these together, the available for sale plus held to maturity, you would get about almost $4 billion of the munis, or at least the state political subdivision, and that's about 33% of the security portfolio, which is a really high percentage. The next highest percentage is mortgage-backed securities, collateralized loan obligations. So, and that's not outside the ordinary. Actually, it's a pretty average amount. So, most banks currently, most of the securities are mortgage-backed. But as we talked about, the bank has a little bit higher percentage of securities than most banks do. So, maybe we need to spend a little bit more time here in the securities. But since the mortgage-backed securities have the implicit and sometimes explicit government guarantee, we know they've got good credit quality. So the only ones is the munis, which could have any kind of potential credit risk, and we can see if they talk a little bit about the credit risk. But as far as the timing of the term structure, we sort of have to look at these, double them together. But so if you did combine available for sale and held to maturity, you would get, there's not a whole lot that's maturing within the first year, at least according to the split note. They could be repricing sooner than that. We don't know. We would have to look at the call report, which we will later. But as it is, only about 5% mature within the first year, and 14%, so it'd be about 20% mature within the first 5 years. So that's not very quick, but as we saw, they've got a lot of cash on the balance sheet, so not really a liquidity issue. But as far as a repricing issue, there's a risk that they're kind of trapped into lower yielding securities for a long time. But like I said, once we dig into the call report, we'll be able to see a little bit more about the timing of the loans and the securities and when they reprice. But I'm going to pause the video right here for a second so I can see if they discuss anything about the credit quality of the municipal securities. I do think that they've got a reserve here. I think that's what this is, held to maturity maybe, of about 3.8 million. And so they've got, what did I say, 3.8 million or 3.8 billion dollars of muni securities. So that's a really small percentage of them. But I'm going to pause the video for a second and kind of scroll through and see if I can see any discussions of it, and then I'll open the video back up. Yeah, so here they talk about it a little bit. So the Treasury agencies, GSEs are all, of course, backed by the U.S. government, so not much risk there. And so then here they talk about the munis. So the majority of them are general obligation bonds, which have very low historical default rate since issuers, so the government they have unlimited taxing authority, so they can get more money to pay down the debt if they need to. So they do say that they did record a $4.8 million impairment on one corporate available for sale security, but the corporates are pretty small percentage, I think. Yeah, they've only got $330 million of corporates. That's about 3% of the securities portfolio. So I think that's a big material risk there. Although you can see there's a few cracks in there, but it doesn't seem like that's that big of a deal. But this is just the available for sale securities. They say there's no ACL on the available for sale securities because the decline in fair value is due to interest rate changes, not necessarily to credit issues. Let's see what they say about the held to maturity securities as well. So again, they say the agency's GSEs, guaranteed by the U.S. government, so nothing there. So they don't record an ACL for that, so that's fine. And for the munis, they reiterate, low historical default rates since they're general obligation bonds. We do have some credit quality rankings here, which is useful. We can see that most all of them are investment grade credit quality. It also says they were all current and non-past due. So, I feel pretty, after looking at all this, it seems like all they've got a good credit quality position in the securities as well. As we noted, that securities represent a pretty large portion of the balance sheet, at least compared to most other banks. So, it looks like about 27% of the balance sheet. So I feel like they've got a good credit quality there. So, no potential issues that I could see. So that's good. Skipping on past. So borrowed funds. So the main one we've got here is, from the FHLB and Federal Reserve, $1 billion plus $800 million gets us about $1.8 billion. And then we've got some trust preferred securities here. That adds up to about $76 million. And trust preferred securities are typically at variable rates, so those reprice pretty quickly. And then the subordinated notes as well. There's about a little over $300 million of subordinated notes. If you would read this, you would see that they basically reprice in 2025 or in 2027 and become at floating rates at that time. So that's when the repricing risk would come into play. But I do believe that the bank term funding program, I think these were 1-year loans, and so they probably reprice within the next year. And then this $1 billion from the FHLB, there was a short-term advance as well, so that will reprice within the next year. So we've got kind of a lot here that reprices really quickly, which is a risk. So, these interest rates are pretty average, pretty right on par. But they will reprice within the next year, so they'll become more expensive that time if the company keeps them on their books. The trust preferred securities are at variable rates, so of course they go up as interest rates have increased over the past little time. So they're at high rates, but it's only $75 million, so not a whole lot of money at risk there. These will reprice for the next few years, so not too bad, but there's a lot of repricing risk with these FHLB Federal Reserve borrowings, but we can look at that in context with the assets as well, compare the timing of the repricing of the liabilities to the timing of the repricing of the assets and kind of assess that. The other big repricing risk comes from the repurchase agreements here. So they've got about, it's like almost $2.2 billion. I was thinking it was more than that. Yeah, I think it's about 2.26 billion. But anyway, these reprice within 2 to 29 days, 30 to 90 days, over 90 days. So we can see that most of these are repricing within a year. So that's another risk as well. So basically, by looking at the liability side of their balance sheet, they've got 2.2 billion plus 1.8 billion plus maybe 80 million of this that reprices within the next year. And when that reprices, it'll reprice at higher rates. So that's going to squeeze their net income. But we've also got assets that reprice, and hopefully the repricing of the assets happens as well, or quicker. And so that will allow them to make more money on the assets than they do on the liabilities going forward. Anyway, so let's go back down and continue our exploration of the footnotes. Might have gone too far here. Oh, here we go. Okay. Yep, so the debt, and then a little bit about the revenue recognition, commitments and contingencies. We usually don't look at this too closely, but this was kind of unusual. So commitments to extend credit is $12 billion. Commitments to extend credit cards, $5 billion. And if you add these together, that's about $18 billion. And so 18 billion as a percentage of loans is about 76%. So basically the unborrowed line, or on credit cards or other loans, is it's not going to happen. But if the customer did draw on all of that, it would almost double their loan portfolio. So of course, it's not going to happen, but it's certainly a risk from a liquidity standpoint. But it's also sort of a benefit from a growth standpoint. So it just kind of depends on the balance that they keep there. But as it is, 76% of the loan portfolio, we usually see this, commitments to extend credit is about 20 to 30% of the loan portfolio balance, and these guys have got 76%. I feel like that's a pretty big risk from a liquidity standpoint as well as a capital standpoint. So we can keep that in mind once we kind of get down into considering the capital position. As we saw earlier, I mean, they've got a lot of cash compared to most banks, and a lot of securities compared to most banks. So I guess we can talk about it now. But if you combined the cash plus the unencumbered securities, that's what we would call the on-balance sheet liquidity. That gets about $9.4 billion, and that's about 25% of the deposits. Of course, $9.4 billion isn't $17 billion, but there's probably an unlikely chance that all the customers are going to borrow every cent that's here. But as I don't know if I mentioned it before, but the bank is also entered into an agreement with I think Bank of America and Morgan Stanley to raise some more capital. So they're raising about 2.8 million shares, I believe. So that would give them some more. Not raising that much, they're issuing 2.8 million shares to bring in some more equity capital. So that'll give them some more cash as well. So anyway, that this is a lot. But, I think when we look at it from the perspective of that the bank is really well capitalized, but also really good liquidity position. Maybe it's not that big of a risk. Derivatives. So I believe they have both cash flow and fair value hedges. Nope, just cash flow hedges. So yeah, so they terminated their fair value hedges anyway. So the cash flow hedges is usually pay fixed and receive a variable rate, which I like. It mitigates interest rate risk, especially in the way that these guys are using it, because it's hedging the interest on the trust preferred securities, which we talked about. I think was around $80 million or 75 million, $79.5 million. So they're hedging 51 million of the trust preferred securities, 51.5. As we talked about, the trust preferred securities are at variable rates, right? So by cash flow hedging them, they've converted those variable rates into a fixed rate, and that way when interest rates go up, they don't have to pay more interest on those debts. Anyway, so I think that's a great play. It's a really small amount of the entire liability side of the balance sheet, but every cent helps, I suppose. Looking at the fair values, we can compare the fair value of the net assets of the bank to the basis that the balance sheet is under. So we can see right here. So as is typically the case, held to maturity securities have some unrealized losses here. So it looks like about 600 million, and then the loans also looks like about $150 million loss or so. So all in all, about a $770 million reduction to equity, which is about 24%. So it's not too bad, given most other banks are somewhere between 25 and 40% reduction once we convert all these things. But what I thought was weird is that there's no difference between fair value and book value on the liability side. I mean, normally you would see at least some of the debts or time deposits at least, but even the time deposits equal. So either that's incorrect, or maybe they just didn't find it material to show the difference. But I do know that the other borrowings are the FHLB, which repriced pretty quickly. So I could see, as well as the repurchase agreements, which also reprice really quickly. So I could see there not being a whole lot of difference between fair value and book value, since there's such a short time to maturity. But anyway, I feel like there should probably be some differences in here, but maybe it's not that big of a deal. Anyways, so if we converted all the assets and liabilities to fair value on here, that gets us about, if we were to compare it to the market price in the stock market, it would get us about 1.94 times. So we'd be paying about double for the net assets of the bank at their fair value, which is pretty much in the middle of the normal range of what we might see. Usually see somewhere between 1.5 and 2.5, so not that unusual. Probably a pretty fair price. And if we're looking at a fair value and we take the net assets divided by the assets recorded at their fair value amounts, we get about a 4.76% that we can consider kind of equity capital at its fair value, which is kind of on the lower end of the range. So of where we normally see, so it's a little bit lower capitalized than the average bank, at least from a fair value perspective here, but not at a insolvent place. Last year when there was such a run up in interest rates, and it pushed the fair values of the securities and loans to such a low place. We saw a lot of negative fair values of net assets. Where the fair value of the liabilities was worth more than the fair value of the assets, and that's not good. But as interest rates have kind of leveled out and banks have had time to reorganize their balance sheet and push things in the right place, we don't see that as pronounced anymore. And actually, a lot of the banks are now kind of at normal ratios there. Anyway, so these guys are at the bottom of the range of capitalization, but not at too bad of a place, I think. Yeah, and so here's a little bit about the subsequent event. We talked about how they're buying Heartland Financial at 0.55 shares per share of Heartland. That comes out to about $2 billion. That's what we talked about. All right, we calculated that correctly then. But, on top of that, they're also issuing 2.8 billion shares, and also gave the underwriters an option to buy more, and they did. So 2.8 billion shares is, there's about 48.5 million shares outstanding right now. So issuing, actually when you add in the 420, that gets us about 3.2 million. That's about 6.6% of the current amount of shares. So that the people that currently own the company will get diluted by that amount. So that could say your earnings per share, dividends per share, that kind of stuff. If the bank keeps its same profitability, will reduce by 6.5%. So. Hopefully they use that capital to reinvest and make more money. So maybe it works itself out, but that's something to consider. All right, so we're down in the MD&A, and we've been going through a lot of this in detail, so we can probably skip over some of it. But the loans, 5.31%, or at least the total interest earning assets. Like we talked about, they're a little bit more weighted towards securities and cash than they are to loans. So that makes sense why this yield is a little bit lower than what we typically see, at least for this quarter's financials. They also have a pretty high yield on loans, which we saw is because they're more heavily toward commercial loans, which is great. Also a little bit higher, it looks like interest-bearing liability yield. Part of it is the borrowed funds, because a lot of the borrowed funds come from FHLB. Also interesting to see is that their deposits also yield pretty high amounts. So 3.84% is a pretty high amount. Repurchase agreements 4.67, that's a pretty high amount. Yeah, so that's why they've got such a small net interest margin, 2.48. We're usually looking for something like 3%. So it's unfortunate that they've got such a low net interest margin. But it's surprising because they had such a high amount of non-interest bearing deposits, which is about 25% of the loans. So yeah, $10 billion here. But even that didn't help shore up such a large net cost on the liability side. So coming on through, we've talked a lot about loans and securities, non-interest income. Like we talked about, they're making big money in the non-interest income, which is awesome. Part of it is the investment securities gains and losses here, which we could take out as kind of a one-time thing if we wanted to, but it doesn't end up being a material amount, so we can just kind of leave it. I don't think it would affect any of our conclusion on any of the ratios or any of our any of the analysis. And keeping on coming through, wanted to see, yeah, capital and liquidity. So we can talk a little bit in detail about that now. As we talked about, from a liquidity standpoint, they've got a lot of cash on the balance sheet. About 15% of their assets are cash. They also have a lot of securities. About 17% of their assets are securities. So they've, got a really good liquidity position here. But about 81% of their securities are pledged. So, when you look at this from that standpoint, they've got $7 billion of cash and about $2 billion of unencumbered securities. So, even though they had $12 billion of securities, about $9 billion of them are pledged, so they can't really access that in times of need. But having pledged that, they do have access to funding from FHLB and the Federal Reserve of about $12 billion. So they basically pledged about $9 or $10 billion of securities and $17 billion of loans, and now they've got access to borrow about $12 billion from wholesale funding sources. So, if you were to add the on-balance sheet and off-balance sheet liquidity, if you were to add those together, you get about $26 billion of liquidity, and that equals about 71% of deposits, which is it's a pretty average amount, adding in the on and off balance sheet liquidity. So that amount as a percentage of commitments is, we were concerned that they've got $17 billion of commitments, which is a pretty high amount. So, their on plus off balance sheet liquidity is about 143% of the commitments. So they've got enough. In the unlikely chance that every one of their customers drew down their lines to as much as they could get it. And that's a really low amount compared to most banks. Most banks have somewhere between 300 and 500% of their commitments, but these guys have 143%, so it's enough to cover it. But it's on the low end. So, but the on-balance sheet liquidity, we said they have $9 billion of unencumbered securities plus cash. That's about 25% of their deposits. So, and that's double what we would see for most banks. So they have a really good liquidity position, and perhaps when you add in the off-balance sheet liquidity, like the wholesale deposits that they've pledged collateral for, they will have additional sources of liquidity if they were to need it. So I feel like they're in a pretty good liquidity position. We mentioned the fair value of its net assets relative to the fair value of its assets is pretty low. It's at least on the low end of the range what we might see. This is a really big bank. It's not uncommon for larger banks to have a lower capital position. There's a lot of academic studies around that find that that's pretty commonplace. So, and a lot of it is because of the tail risk and bailouts, right? So if you're a larger bank, you're more likely to receive favorable treatment from the government programs, but also they've got a lot of cash and a lot of securities. So as far as like capital itself, they may not necessarily need that much since they've got enough liquidity. Anyway, so the capital ratios, I don't know if we skipped past that part or we just haven't made it to it yet. think maybe we might have seen it somewhere else. But anyway, so their regulatory capital ratios are pretty low as well. Oh, this is them right here. Okay, so common equity tier 1 total, and leverage ratio. So these are all below what we would normally see for most banks. But this bank is more allocated toward commercial loans, which get dinged and when they do the risk adjusting. So I could see that being the case. So not only being on the lower end of some of the lower end of the capital, but also being more allocated toward commercial loans. You could see this being a little bit on the lower end, but it's not outside the range from being well capitalized. So from a regulatory standpoint, or from a dividend paying standpoint, or the ability to merge with another bank, something like that, it's not really at risk, I don't think. So just kind of something to realize about this bank. But we can also see equity to assets, 7.48 a percentage, I suppose. So yeah, 7.48% of equity divided by asset. But when we converted everything to fair value, that got somewhere between below 5. So for most banks, we see somewhere between 9 and 10% for this. So these guys are 7%. So now that we've kind of looked at all these capital metrics in perspective, I could see that the capital position of the bank is a little bit lower than the average bank, and maybe from that we should expect a lower price for the bank than what we would normally expect, given all those considerations together. And actually, one thing to note. By looking at the call report, you can see how many uninsured deposits they have, and it's about 25 billion, and that's about 68% of the deposits, and that's a really high amount. It's about double what the average bank has in uninsured deposits, so that's certainly a risk. Those are more at risk of deposit flight, right? So if the bank were to have deposit flight, where people pull money out of the bank, then they would have to draw on their liquidity, which I think they would be able to. But given these lower capital ratios, the fair value of the equity, the regulatory ratios, those things of that nature, I feel like we should rate the capital structure of the bank a little bit lower than what our average bank would be. So give them a little bit of a ding. But I don't think that it's an issue for the bank going defunct or anything like that. It's just a little bit less capital there. And given their size, maybe that's okay. But so coming down to liquidity risk, we talked a lot about that. Operational risk, I have skipped over the interest rate risk. Yeah, here we go. So I'm looking at the hypothetical rate shock within the first year. So what happens if there's all of a sudden 100 basis point increase or 200 basis point increase in interest rates? What happens to the net interest income of the bank? And in this case, there's not a whole lot of risk here for really volatile changes, and in fact it's kind of neutral. It's not really asset sensitive or liability sensitive on a major basis. So I feel like the bank has, just from this, it looks like they've done a really good job matching the assets to liabilities. And that's particularly a big achievement because, as we saw, they've got a lot of, debt that reprices within the next year. And also their securities. It looks like, at least looking from the call report, most of their securities, 56%, reprice in 5 to 15 years. And if you add in what reprices after that, 73% of their securities reprice after 5 years. That's a long time to be stuck in these interest rates with the risk that, market interest rates go up and they're stuck at these lower rates, and can't participate in the higher rates, at least from the securities. But the loans is what saves them. So 59% of the loans reprice within the next year. And that's a really high amount. So, even though the securities don't reprice really quickly, and they've got a lot of debt, and also a lot of savings accounts, which, reprice really quickly, they have enough loans that reprice within the next year to keep things really, really neutral. So they've done a really great job reducing the risk of credit risk here. And so, I grant that, really below average interest rate risk here. And we talked about the loan quality. I mean, it's like stellar loan quality, and also really sufficient reserve as well. So, if we wanted to reiterate a lot of, the liquidity type stuff, they talk a little bit about securities being pledged. Also, a lot of, the commitments. They've got 18.4 billion of commitments there. So, there's a risk there. But we've kind of already kind of drilled about that. So, I think this gets us to the end of things. I also talk about a little bit of the risk of Heartland, but we talked about that in detail as well. So they've got about 1 million shares that are authorized to repurchase, and so that's about 2% of the shares outstanding right now. As we talked about, they're issuing 2.8 million, so that doesn't really offset it that much, but it is what it is. All right, so this is the end of the thing. So we can kind of recap, summarize our key determinations here. I think that the profitability was really good. Maybe the net interest income not so much, but they had they make really good money on the non-interest income. And of course, being a big bank like that, they're able to offer a lot of ancillary services that give them a lot of extra money, and they also have really low non-interest expense. So those things together makes it a really, really profitable bank. And with their return on assets about 1%, which is it's pretty average for a bank. So good job on the profitability. As far as the risks that they have to take to get that, we can talk about those. From the interest rate risk perspective, we just talked about that, and I feel like they've got really good, really below average interest rate risk due to most of their loans repricing within the next year, which appropriately offsets a lot of the liability side repricing quickly as well. So I don't think there's a whole lot of risk there of them getting squeezed if interest rates were to go up. And actually, looking at the particular paragraph and table in the MD&A about it, we can see that no matter which way the interest rates go, they still kind of keep the same profitability. So that's the definition of risk, is that it's volatility, right? No matter what happens, we're almost guaranteed that we'll keep the same amount of income, at least when it comes to interest rates. So really good interest rate risk. Credit quality, we saw that they've got almost zero past due loans, almost zero non-accruals. The classified loans are really low compared to what the average bank has, and they also have a reserve that appropriately covers those classified loans and more than covers the non-accruals and past dues. So I feel really good about the credit risk as well. I feel like they're really well reserved, and that the portfolio itself is really good quality. And then looking at the liquidity capital risk, this is a tough one to kind of decide, like an ultimatum. Is it good? Is it bad? I feel like, with there being a lot of uninsured deposits, I think it was 68% or so. That's a risk for some deposit flight, which would pull from the liquidity. But they do have, I think, 15% of their assets is cash, and then another, 27% or so it comes from securities. So, and then they pledged a lot of those, but taking into account the amounts that they can borrow from the FHLB and the Federal Reserve, they've got a little over 70% of their deposits in on and off balance sheet liquidity, and about 25% of their deposits in on balance sheet liquidity. So, but we did see that a lot of the capital ratios, for instance, the common equity to assets ratio, at least both converting to fair values and keeping the balance sheet amounts, it ends up being pretty low ratios. But then we've also got $17 billion of commitments there, and the amount of liquidity compared to those commitments is pretty low compared to what the average bank is. They have enough to cover them, but in the unlikely event that they would all be drawn down. But so anyway, all that to say, I feel like that there's a bit of a concern that the capital of the bank is not an average, what the average bank might have in place. It might be a little bit on the lower end of the average bank. So for that, we would kind of prefer that there be a lower stock price to compensate us for that, right? Taking on that risk. And if we were to compare the earnings of the bank to its current market price, we saw that it's almost 11%, which is on the high end. It's 11% earnings yield, which is on the higher end of things. So we are getting a pretty good earnings yield, at least on the high end of what an average bank might have. And also the price relative to the net asset value of the balance sheet is pretty average as well. It's about 2 times. It's not a super great cheap deal, but it's a pretty reasonable average, right in the middle price. So given that we've got some pretty really below risk type things like the interest rate risk and the credit quality risk, but then the liquidity and capital risk is a little bit iffy, but we're getting a pretty cheap price on the earnings and a pretty reasonable price on the net assets of the bank. So I feel like getting 11% earnings yield on this bank is a pretty good deal, and that's buying the bank by itself. We also have the issue of, well, how does the bank look with Heartland, right? And we haven't delved into the details of that just yet. We might know more once they issue some pro forma financials or more information about that. But as we talked about, Heartland had some capital liquidity or below average capital and liquidity, so it was a little bit higher risk from capital and liquidity, but also I believe from loan credit quality. Right. So if UMB has capital and liquidity that's a little bit iffy, and then it brings on Heartland, which also perhaps has below average capital, does that put more strain on things? And perhaps that's why they might be raising more equity. And in fact, now that I think about it, I could see that being one of the conditions for the regulators approving the merger. I don't know if that's the case. I'm just kind of maybe making stuff up. But they are raising the 2.8 million shares plus the 420,000 options, so that might be to add some more capital and liquidity to make the combined bank a little bit more robust capital position. So maybe that makes it okay. Anyway, so I feel like the 11% earnings yield on the bank itself is a good price to pay for it alone. And adding in Heartland, which is going to be about half the size of what UMB is, or kind of close to it, it'll have a material effect on the earnings and positions of the bank. So at the current market price and last year's earnings, it'd be about a 10% earnings yield Heartland would get. Like if you paid $2 billion, which is the purchase price for it, if you paid $2 billion for its last year's earnings, you'd be earning about 10% on the purchase price, which is actually really good, and especially for an acquisition like that, because you usually pay a lot more than what the market price is. So these are, would normally be outside the range of a normal bank, but it's actually within the range. So, maybe that's a pretty average price. But we did note the capital risk and credit quality risk. But if you were to buy the net assets of Heartland, you'd be buying them at 4 times what the net asset value is on the books, at least as of December 31st. That's when we did the analysis back in March. So anyway, those are some things to think about in the when you're considering what does the combined bank look like. But I think buying UMB standalone is a good fair deal. Buying the combined, buying with the anticipation of Heartland coming on board, we would need to do some more detailed analysis of it. But as it is, it seems like it might be a fair deal, and you'd be bringing on a bank that's earning 10% on what you paid for it, and and maybe the capital and credit quality risk is shored up with what's happening in UMB right now. Issuing of the 2.8 million shares, but also UMB having superior credit quality as it is. So I feel like the combined bank could be a good buy, or at least buying UMB now with the anticipation of Heartland coming on later could be a fair deal. But I want to caveat that we didn't do really detailed analysis on it. So anyway. That's my thoughts on the thing. Let me know in the comments if there's anything else that you feel like it's important to add, or where you might disagree or agree with what I said. I'd love to hear what your thoughts are. So thanks for listening. See you on the next one.